Hello, it's Tuesday the 14th. I'm FxPlew and this is the market brief. So we're seeing less mortgage lenders willing to offer those fixed rate deals, and that means that proportionally more mortgage payments are set to rise with each future rate hike. Indeed, the MPC is expected to raise rates again next week, and while the independents have been on talking up their voting intentions, it's less clear if the bank officials will vote for 25 basis points or 50 basis points as a rate hike, because it's also pretty unclear whether the vote will be affected by the collapse of Silicon Valley Bank. While that is still rippling through the tech and financial sectors, of course, HSBC stepped in to buy the UK operations yesterday, and that helped see a degree of confidence return to the market. Meanwhile, Chancellor Hunt, he's pretty confident that any fallout can be easily contained. He believes that this is much more of a US issue anyway. And indeed, over in the US, the Treasury is project managing the issues from SVB, but the Fed is also very much involved as well. For one, they need to get their story straight because questions are being asked about whether there was a failure of bank supervision, which of course is a central bank responsibility, and indeed where all the rate hikes may have played a part in the collapse. It might help to back things up a little and fill in a little background here, because SVB saw huge inflows of cash from a lot of VC-backed tech companies during and after the pandemic. Many would even say that they acted prudently because they invested much of that money in mortgage-backed securities. However, these holdings started to lose value as the interest rates started to rise. And meanwhile, the SVB client base was typically VC funded and typically running their businesses at a burn, which means they typically spend an awful lot more money than they actually earn. Well, that's a whole nother conversation for a whole nother day. It means that they when things ramped up after the pandemic, this added cash flow pressures to the bank balance sheet because it started to draw on the bank's liquidity. Where the SVB portfolio had got to a place where they either needed to hold the bonds to maturity or sell them for a loss, this cash flow pressure rather forced them to act. When they announced that they had sold a bunch of their portfolio at a loss, despite the plan to recapitalise via a sale of shares, this triggered a run on the bank, where the account holders tried to get their money out pretty quickly. Rather ironically, it was the VC backers advising their tech company clients to pull their money out that quickly exacerbated the problem. And that's just the big money world that we live in right now. But anyway, the Fed was given basically 48 hours to re-establish the market confidence, and the Federal Deposit Insurance Corporation needed to guarantee all the deposits rather than the normal 250 grand limit to help with that. No doubt the VCs lobbied for that decision because there was a lot more than 250 grand in most of those tech company accounts. Because, of course, why would those tech companies deploy resources on financial prudence and counterparty risk management? Those resources could be deployed towards speed and momentum and growth, all that growth demanded by the VCs. Do the tech stuff, deliver growth, get more funding. Those are the rules of the game. And don't forget, growth is the new profitability these days, right? But just to clarify the craziness, Biden was on to reiterate two main points of contention. One, this was definitely not a bailout. And two, the taxpayer definitely won't be covering the costs. We'll see about all that. Cheerio.
If you do not have a clue, then just tweet through and ask FxPlew.